Hey everyone, and welcome to this explainer. Today, we are unpacking a genuinely fascinating business case. We're looking at how Inditex, the massive parent company behind Zara, is completely defying the current macroeconomic turbulence. They're not just surviving, they're actively thriving in a hyper-competitive European retail sector. While other companies are basically just bracing for impact right now, Inditex is writing a totally different playbook, and we've got the 2026 data to prove it.
Okay, let's dive into this massive question right out of the gate. Is traditional retail actually dying? Because, if you read the headlines lately, you'd think brick-and-mortar retail is completely on life support. A lot of traditional apparel companies are really struggling right now, and they're all pointing to the exact same things: weak consumer sentiment across Europe and absolutely skyrocketing costs. But when you actually pull up Inditex's 2026 performance data, it tells a wildly different story. Like I said, they aren't just surviving, they're absolutely crushing it.
So, here's how we're going to break this down today. First, we'll look at the core thesis, then dive into the financial proof, uncover their secret sauce, navigate the risks, and wrap up with the final verdict. Let's get right into it.
Section 1. The core thesis. Defensive stability meets tech growth. Our overarching premise today is that Inditex is successfully marrying the defensive stability of a traditional value retailer with the explosive growth trajectory of a tech company. And this divide in the market is just perfectly stark right now. On one hand, you have the typical retail experience in 2026, peers getting heavily squeezed by rising costs and weak consumer sentiment. But on the other hand, you have Inditex's reality. They are executing this premium strategy, leveraging their insane supply chain to just grab market share right out of the hands of those weaker competitors. And the crazy part? They're actually increasing their profitability at the exact same time.
All right, moving on to Section 2, the financial proof, looking at their record Q1 2026 results.
Now, we can't just sit here and claim they're thriving without the hard evidence, so let's look at the numbers. The real headline grabber is this staggering first-quarter sales figure, 8.75 billion euros. That represents a really solid 5.8% year-over-year increase. But honestly, even more impressively, if you look at constant currency, that increase jumps up to 8.8%. This is a huge metric because it proves that the actual underlying consumer demand for their clothes is even stronger than the headline number might initially suggest.
And you know what investors absolutely love? Seeing that top-line success flow straight down to the bottom line. Net income came in at 1.38 billion euros, which is a 5.4% jump. But look closely at what happened alongside that. They expanded their gross margin to 61.2%. Think about that for a second. In a period literally defined by high inflation and rising cotton prices, actually expanding your gross margin by 67 basis points, that is a massive achievement. It signals incredible cost management and serious pricing power.
Furthermore, their balance sheet is just an absolute fortress right now, fortified by a massive net cash position of 10.8 billion euros. If you're an investor, seeing that kind of cash on hand does two vital things for you. First, it guarantees a confirmed dividend of 1.75 euros per share, which is returning serious value. And second, it gives the company incredible investment firepower. They can just keep innovating and pushing forward while all their competitors are stuck playing defense and cutting costs.
Now, what's really wild here is the sheer acceleration. From that 8.8% constant currency growth in Q1, underlying demand actually pushed early Q2 sales up to an incredible 11.5% constant currency growth between May 1st and June 1st. This kind of momentum is basically proof that consumers are highly responsive to their new collections right now.
Okay, Section 3, the secret sauce. Let's look at their three strategic pillars.
To understand how they're actually hitting these numbers in a high inflation environment, we have to sort of pop the hood and look at their internal machinery, starting with their fashion speed supply chain. While competitors like H&M or Primark are currently drowning in surplus inventory, Inditex's agile logistics let them operate on a totally different timeline. They can design, manufacture, and distribute new garments globally in literally weeks rather than months. By reacting to real-time consumer data, they only make what people actually want to buy. This drastically reduces the need for markdowns and protects that massive 61.2% gross margin we were just talking about.
Let's move to the second pillar and see how this all builds into their broader tech strategy. At their 2026 General Shareholders Meeting, CEO Oscar Garcia Maceras confirmed that artificial intelligence isn't just a side project anymore. It is now fully embedded across their entire organization. In design, AI is predicting trends before they even peak. For inventory, it's optimizing stock allocation across more than 5,800 global stores. And online, AI is personalizing the shopping experience to drive up conversion rates. So this isn't just buzzword hype, right? This AI integration is actively driving the real-world productivity and profit gains we just looked at.
The third pillar is their store expansion strategy. Remember that question we asked at the very beginning, is retail dying? Well, rather than running away from brick and mortar, Inditex is doubling down. They're investing a massive 2.3 billion euros in 2026 alone. But here's the catch. They aren't just opening traditional shops. They're transforming these physical locations into what they call technological stores and omni-channel fulfillment hubs. They are seamlessly blending the online and offline experience to drive incredible customer loyalty in a way that purely online e-commerce brands simply cannot replicate.
Section 4. Navigating the risks and macroeconomic headwinds. Of course, objective analysis demands that we look at the potential roadblocks, right? Because no investment is totally immune to global pressures. The first major risk here is margin pressure. While Q1 enjoyed fantastic margin expansion, the CFO has explicitly cautioned that the sourcing tailwinds they've had from a weak dollar are starting to fade. What that means is, as we head into the second half of the year, rising raw material costs and increased freight rates could definitely start to compress those margins.
We also have to track regional instability. The company has already noted impacts on sales in the Middle East due to geopolitical tensions. On top of that, any sharp global economic slowdown will naturally hit consumer demand for discretionary things like apparel. Finally, we have to keep an eye on a forecasted growth deceleration. Because of tough calendar shifts and really strong year-over-year comparisons, analysts are projecting that growth will slow down to around 7% in the second half of the year. Put all this together, and the second half of the year is shaping up to be a much tougher test than the first.
Which brings us to Section 5, the final verdict and market consensus.
So, considering this incredible technological momentum versus those very real macro headwinds, where does Wall Street actually stand? Well, a consensus of 24 analysts currently maintains a unified buy rating on Inditex. They've got an average price target of 58.18 euros. Now, it is worth noting the pretty wide range of estimates here, stretching from 48 up to 71 euros, which definitely reflects the uncertainty around those global macro risks we just covered. But ultimately, analysts view this stock as a core hold for long-term investors who are betting that Inditex's AI-driven efficiencies and massive scale will be enough to offset rising raw material costs.
And that brings us to our final thought. Inditex is just an incredibly rare example of a legacy retailer successfully transforming into a high-margin, tech-enabled growth story. But because their current valuation is essentially pricing in perfection, we have to ask ourselves, will their AI-powered hyper-fast supply chain actually continue to outrun global inflation and geopolitical stress, or is a retail reality check eventually inevitable? It is a truly fascinating space to watch, and I hope this explainer helped clarify exactly what's driving their current dominance. Thanks so much for joining me today.